Figured it out early, y'all. What is
Yes.
Mark? How you feeling?
I'm feeling so much better. So much better. Thank you to everybody out there that was sending me warm wishes and checking in on me and seeing how I was doing. I'm doing good. Feel a little bit more revived and everything else, which you'll probably see in today's episode. I'm coming in hot, just to let y'all know. But yeah, I'm feeling good. I'm feeling good. How are you?
Well, there's been a lot going on, like I said, behind the scenes.
Indeed.
You know, I don't want to get into that right now, though. But
All
just know
good.
that there are a lot of, as you know, there are a lot of good things. Everything is shiny and brand new, floating on clouds and all that good stuff. So,
Nice, nice,
yeah,
nice. Well, you ready to get into today's episode? Because we got a lot.
I am. I'm so ready. Like, hell yeah, hell yeah.
Yeah, because I was like really bummed out that I couldn't do yesterday's episode or last week's episode live. But hopefully, like for folks that were paying attention, you were able to see some of the things. But I'll be able to explain them today.
Yeah.
But yeah, so I'm really excited. I hope that everybody was able to also enjoy that episode that we dropped. I tend to keep some of those episodes in the background just in case if something transpires. That episode I think was filmed back in January, so it's interesting how it's starting to be. Hopefully, like the things that we release are very like relevant across the board, no matter what. So, but let's get into it. What's up, everybody? I am Mark Monroe, accompanied by my wonderful co-host, co-producer, co-creator, and good friend, and coming through with the swag I see over there. All things brand new, freshly twisted, and everything else. Give it up for none other than Lady.
It's Jill NGC in the place to be. What does it, cousins, on this fine Tuesday?
Yes, and on this fine Tuesday, welcome to another episode of the School of Investing. Now, this one's going to be a little bit interesting because you get to see exactly kind of like what my notes look like a little bit, and me going back and like kind of like just taking you through some of the chart stuff. But if you haven't subscribed yet, though, because you definitely need to subscribe because there's a ton of other great content that also like is in our bag that you can go back and look at and keep watching so that way you can gain more perspective and rewatch it again just to see exactly like, hey, did you actually pick it up? And then on top of that, go ahead and like this video. It doesn't take that much to just click that like button. We were totally we are totally grateful if you do. And on top of that, if you want to be in the know, just like how Raphael
Hey,
said, I am
Raphael.
ready. He was ready to
Ready,
go.
ready.
Then go ahead and hit that bell so that way you can be a part of the notification squad, aka the Cool Kids Club. So, Jolene.
Yes. Get into it.
All right, you can see that I'm amped. So, like, I got like 2 weeks worth of energy. Like, I sat back, I waited. I was sitting there in the darkness. I felt like I understood what it was like to go back to the shadows and just like regain my energy and
Okay.
regain perspective. I'm ready.
Yeah, I do have to say it was a nice. While you were suffering, I did keep you up in prayer, but I was on vacation, so I was willing to, show up if we needed to for the show. But I'm also glad that you rested because Mark, you like just be
I
going.
don't rest.
Yeah, and you really get to take the opportunity to rest. So I'm glad that you are healed. The healing vibes are up. So let's get into these markets. So y'all, today is Tuesday, and the market was flat. So let's talk about it. So the Dow was negative 222.84 points. So now we're at a level of 32,990.12. S&P 500 was negative 26.09 points, which leaves us at a level of 4,132.15. The NASDAQ was down negative 49.74. Now we are at 12,081.39. And the US 10-year, 2.86%. Interesting. We'll talk more about that. And the VIX coming down a little bit to 26.19. Heading over to sector performance. As you know, there are 11 sectors. We track the top 3 and the bottom 3 so we can see what that rotation is looking like. We got consumer discretionary, communication services, and financials in the top 3. I will note that financials are negative, along with the following: utilities, materials, and energy. Interesting about energy, Mark. Energy has really been up since last year, really. It's
I
been
think
up.
since November of 2021.
So, just something to just be mindful. Be mindful of that. I'll go back. I'll bring this up in a moment. Anyway, so we have our picks, y'all. So if you're new here, you can find the Come Up Series picks, aka the Sips, on our Instagram page at that Come Up Series. And we have Amazon with a respectable 4.40 percentage points to the upside, Nike holding it up to 2.47 percentage points, and Signature Bank up 2.26 percentage points. Now for the bottom feeders, we have Unity bringing it down to, let's see, they got a negative 3.27%, CrowdStrike negative 4.09%, and Zscaler negative 4.32%. So as you can see, Mark, you see that balance. There's 4%, over a little over 4% to the upside and a little over 4% to the downside. So that is a very, very interesting. So in
Mm-hmm.
the Come Up Series fashion, we want to shout out Brian Clyette, our historian, so we can talk about some Black history all the way until we get to Juneteenth, which is one of my favorite holidays, and it is right around the corner. So here we go. Today we're going to be talking about Frank Greene from 1938 to 2009. Frank Greene is often hailed as one of the first Black technologists. He developed high-speed semiconductor computer memory systems in the 1960s at Fairchild Semiconductor Research and Development Labs. He would later go on to start new technology companies of his own. He also founded a VC firm called New Vista Capital, which focused on minority and female led companies. His legacy as a technologist and an investor lives on today. He's also among 63 inductees in the Silicon Valley Engineering Council's Hall of Fame. Give it up for Frank Greene. Now, what's interesting, Mark, is like there are so many similarities between you two.
Interesting.
Very, very interesting. It's always dope to like find an ancestor who has left some a trail of what they are doing, and then you pick up that torch and carry on. So, you know, shout out to Frank Greene. If you didn't know about Frank Greene, feel free to look more into that. So, Mark,
Yes.
now there are so much to cover, so we definitely have to get into that chart that you dropped last week
Uh-huh.
via a
Uh-huh.
tweet. We definitely want to get into that. But then also, Mark, Biden was meeting. He met with the Fed today,
Yep.
and there was some conversation to be had. And I guess the main thing that I took away from that, as I was just reading different articles on it, is Biden is in this position where he wants to show the American people that, yes, I'm aware and I'm attuned to all of these high prices. I don't want to step on the Fed's toes. I want the Fed to
Mm-hmm.
be independent, which is, it's, in my opinion, it's good to have that balance, like let the Fed do what they do, what they're
Mm-hmm.
charged with. Um, but again, it is a balancing act. We have, inflation on the one hand, interest rates on the other hand, all the tapering talks, and then we're trying to avoid recession, right?
Mm-hmm.
So I think a couple episodes, Mark, you talked about there being a global recession, but the U.S.
Mm-hmm.
remaining strong. So I know we're going to
Correct.
get into that. So that's cool. And then I don't know if you've been following the Shanghai, the lockdown, the COVID lockdown
Mm-hmm.
in Shanghai. I definitely want to talk about like um, how other markets,
Are
world
impacted?
markets are impacted exactly. And
Okay.
also these sanctions on Russia's oil from the EU, who was basically like, look, we all, the leaders came together and was like, okay, look, we all agree we're about 90% of this oil from Russia is about to be sanctioned. And Russia basically was like, we will find importers. Okay, like if y'all don't want to mess with us, we will find importers. But Mark, the question is, who is that likely to be? Is that India? Because last time India was like, now look, we ain't gonna say too much. We're neutral. So, do you see it as India? Is there some other people?
Well,
Or
you have the other players in OPEC also. So, you have Saudi Arabia, and many of those countries that are tied to the oil cartel, that they can
Mhm.
also, become massive suppliers. The United States can ramp up even more production and also become a major supplier. So there's other ways, and I think that another thing is there's conversation now starting to transpire really about rethinking energy in the
Mhm.
sense of, you know, so that way we could prevent even something from this either escalating where it can literally have significant impacts or, you know, really shocks to the market, and really start putting that investment towards alternative renewable energy. I think that those conversations are starting to be had in specific circles. But I
Mhm.
think, yeah, they're going to look towards other. They're going to look at the other players in OPEC to ultimately carry the load.
Now we look at some of the other sectors that make up, or not these sectors necessarily, but we look at the industry, not just the sector, but the industry of energy.
Mm-hmm. Mm-hmm.
Then we break down the different sectors within the industry. Um, it looks like alternative energy is experiencing an upward trend of growth for this year. So that is very telling that what you're talking
Very.
about, like being able to expand our of
Yeah.
alternative uses, you know?
Yeah, you got solar, you got, of course, wind, you got hydro, you even have other things like biodiesel. You also have, say, for example, things where they're using algae to create renewable energy as well.
Mhm.
Those things haven't really, really taken the lead as much as, here it is, there's been billions of dollars of investments that have been made. It's kind of interesting that how they've made those investments towards research and R&D, but yet they haven't really started to solidify themselves in the mass market or in Main Street
Mhm.
markets. So it would be interesting to see how that transpires. But, like the good old Chinese proverb says, all great things take time. But it's going to be interesting exactly how that timeline is going to be challenged, especially when the world is like, okay, it's time. It's
Mhm.
time to come up with an alternative solution.
Okay, so speaking of timelines, can we
Hmm.
look at that chart? I was trying to segue, but
I know. Okay. Yeah, let's do it. And I was really, really excited to share this
Mhm.
last week, but it's good to actually just go ahead and just drop into it. So, for those of you that are here with us tonight, and I'm gonna just let this take a full screen so
Yes.
that way we can literally not have any type of any distractions associated. So here is a chart of the S&P 500. So if you're playing along with us, and I hope you are, I want you to play along with me because there's going to be some things that I'm also going to show you if you've been using, say, for example, such a trading platform like TradingView, where you can use some tips and tricks to actually make some alternative charts for yourself. So of course this is a S&P 500 index. We're pretty much the basic SPX that we're all accustomed to, correct?
Mhm.
Okay. This is where it gets a little bit interesting because, of course, if you look at the S&P 500, you would say, okay, hey, well, I'm not really seeing a trend here. But if I draw, say, for example, a simple trend from really 2016, you'll probably see across the board that essentially that we've stayed on a specific ping line, and we stayed tried and true to it. Across the board. So let me make sure that my oh, okay. So TradingView doesn't want to be my friend today. Okay, great. There we are. So again, it's like we pretty much have stayed across this trend line, and every single time that the market has pinged it, it's like, okay, hey, we're here. Now I'm going to remove this because this is the basic SPX chart, but I feel like we need to go a little bit even further in depth. So what we're going to do is on our S&P 500 chart, what I'm going to do is, instead of going in SPX, I'm actually going to go with US 100,
Mhm.
and I'm going to put that on my chart. So now I got US 100. So US 100, which is the currency view, currency.com view, it gives me the NASDAQ 100. So this is technically the NASDAQ 100. Now what I'm going to do even further is I'm going to put a slash, and then I'm going to put US 500. Now, of course, for everybody that knows, that represents US 100, NASDAQ 100, US 500, S&P 500. I'm going to hit enter, and then boom. Now, of course, I've done some amazing magic here for you guys, so that way you can see some of the things here. And remember that trend line that was drawn? Well, look at that. Boom. When you put it now here, now when you put it at 2016, which is where we started, and pretty much run that trend line all the way across the board, you'll start to see something as it pertains to a long-term trend. So is it interesting that at the same time that we've bounced off of this 1, 2, 3, 4, 5 times, every single time we've pinged this trend line, we've bounced off of it. Now, of course, we go green and then maybe have some subtleness. Now, this is on a weekly base. If I put it on a daily, then that's when it really starts to make some significant sense. So if I restart this chart and then put it here, now you start to see that, oh, okay, 1, 2, and you see a few times, even when we retested. So 1, 2, 3, 4, 5, 6, 7, 8. So we've pinged this trend line 8 times. Now, again, this is the equivalent of the NASDAQ. This is the NASDAQ 100 and the S&P 500. So just so that way you know, so if you go and look at it, you just literally type in US 100 / US 500. And that's how it's going to pull up this chart on your screen. Now, you may have noticed that I've drawn up a few items on this line. What if I was to tell you that there's certain things that could have actually, say for example, alerted you or made you kind of aware that these things were, that were on the horizon. Now, remember, Jolyn, you've been hearing me talk about the US 10-year Treasury yield. I've been talking about that for a minute now, and so here's the reason why. Let's go back into the screen. So as you see here, we have the US 10-year on the chart, right? So it's here for us all to see. We can all see it. Boom. And I'm going to put it back on a weekly base so that way everybody can have access to it. Now notice these top parts here, okay? All right. What happens if I put in the US 10-year and set it on a new price scale? What if exactly to the T,
oh wow,
it literally topped out in the same level and where you saw in 2021 of February, and then also where we topped out in November of 2021, where you saw that again, this is US 500, US 100 and US 500, so NASDAQ 100 and S&P 500 combined, exactly where they topped out. And then if I even go even further, look at exactly where we've come down to in the 10-year back in 2020, all the way down to really that August 2015 level. So if I was able to draw this chart, because mind you, it doesn't go that far out, so it kind of has a cutoff. But if you look at it, it's literally, as we all know, the 10-year has literally been an inverse to the US and the US 100 and US 500. So, but the interesting thing is, look at the levels in which that I was able to draw. So here we topped out, and then of course we had some breakages here. So again, we got to, what is it, almost a 3.5, or so about a 3.25 for the US 10-year. We tried to go back up and challenge those levels again, but again, we topped at about a 3.15, 3.14. Pi, shout outs to it. And then we bottomed, or we had a slight little support level here at, again, a 2.74, and then of course we bounced off of it, and then here we sit at this level of a 2.87, because it tried to jump up to a 2.94 today, and it literally just retreated from that. And then this is where we close. So it's very, very interesting, but if you notice, we're still hanging onto this long-term trend line of what you see here. Now, of course, the ratio here is about a 3. Other interesting point is that the fact is that when you think about the Fed, I think that their target will be at a 3% inflation rate when it's all said and done. So something to watch when you see this chart. So again, I'm going to zoom in a little bit for everybody so that way you can kind of see exactly, again, this is where we topped at. This is where we topped out at for the US 10-year back in 2018. So it was in October of 2018 where we topped out in the US 10-year, exactly to the T where we topped out for US equities. And again, the bottom here which ultimately signals when we got to this level, the market was completely bullish, of course. And then of course, when we bounced up off of this line of that 2.1, or let's say at pretty much negative real rates, then essentially the market started, when we started going up in the yield, of course, the market started to get choppy. And thus, here we are. Now, look at this. Now, normally when you see these swoons that go this diabolical move to the bottom, expect to probably get ready to see a diabolical move in the near future. And what I mean by near future, probably over the next 6 to 12 months. Don't be surprised if you see that US 10-year also head back down to the downside in the same diabolical way that it went to the upside.
Okay.
So something that I just wanted to easily share with folks, because you can do some maneuvering with like some of these things in which that you can see that there's actually some relativity within the market. It's like, and the thing is like we pay so much close attention to all the things that take place in the short term that sometimes we forget to step back and zoom out and see things on a much more grandiose level. Like, imagine it like this. And I'm gonna step into your world for a hot second, Jolene. So please don't butcher me too hard if I get it wrong.
Right. Go ahead.
Imagine you're sitting in a gallery, and somebody like literally puts you directly like face to face with a painting. Your perspective and view only gets to see exactly the vantage point of what your eyes can see. So you really can't see the actual full-fledged art. You can probably see the scrapes of paint, the brush strokes at a very close distance, but you can't see exactly what the canvas is about. You can probably see a few colors, but that's it. But it's not until you step out and you actually see the full-fledged picture, the full-fledged imagery, the full-fledged story, where the image actually starts to tell you the story. And it's the same way that I look at it when we look at it in the market. This to me is like if I'm just looking at a simple brush stroke. But if I zoom out, now I get to actually see a true canvas of what is it that the artist, or say for example the market, is trying to illustrate and tell me. So now I actually have a true-fledged narrative of what the market has just shown us. And this is very interesting because again, it shows us exactly like, okay, hey, could the bond market be a way to help us predict the stock market? Does the bond market dictate the stock market? Or does the stock market dictate the bond market? To anybody that's worked on Wall Street, they will always tell you the bond market also always, if not always, dictates what's going to happen in the stock market. Right. Which leads us into one of our questions. The bond market versus the stock market.
Let's get into it.
Okay, so let's take a look at this. So I'm going to go back to this chart that we've shown up on the screen. And, again, I can even throw in some other things in here, like, for example, US 20-year. I'll even throw that in there just for giggles. And as you can see, the US 20-year is like kind of like all over the place.
Right.
Very, very volatile, very much so. I think that we're going on some significant roller coasters, and if I was to show you other places of other treasury yields, it also will show you a picture. But let me leave it up there for a hot second, because bonds affect the stock market, because when bonds go down, stock prices tend to go up, as you can see on this chart. So when you look at it across any board, yes, when you see the bond market go down, or when you see bonds go down, stock prices tend to go up. And the opposite happens when bonds go up, stock prices tend to go down. Now, in some cases, we see them both go up at the same time. Like, for example, in this particular case where we saw it go up and we saw it, they both went up. Now, mind you, the stock market sometimes can be a lagging indicator. But why is this? This happens when there's too much money, or AKA liquidity, chasing too few investments. Now, remember this for everybody that wanted as a refresher. When we saw the market back in 2021, there was very few companies that were actually lifting the S&P 500 last year. So if you think about it, there was very few companies, but it was really the top mega cap stocks, tech stocks, that were literally pushing the S&P 500 up to its new highs. A lot of the other companies in the S&P 500, they were along somewhat for the ride, but yet at the same token, it's like, it was really like, your companies like Apple, Microsoft, and all those other major cap that were literally lifting it. So what happens when you start seeing that, anytime when you start seeing that, it's a very few set of companies that are ultimately lifting the stock market. That's letting you know that we're getting toppy in the stock market. So which means that we're on our last little leg of exhaustion, and then essentially we could be taking a tumble. And exactly what happened, you saw a lot of those capped stocks started to get hit, and then mega cap started to get hit, and then of course the S&P 500 went for a ride. And this could take place also when some investors are optimistic and others are very pessimistic. So you have pretty much an inflow or influx of differences as it pertains to sentiment. And then there's times in which that they both fall, which we've probably seen throughout the year, where we saw the bond market or the 10-year treasury drop, but yet at the same token, the stock market also went down as well. Now, those things tend to happen, but this happens when investors are in panic and sell. They're in panic mode and selling off their investments. So that typically takes place, and we saw that also throughout this year. Now, let's bring it into perspective. Because once upon a time we had a gentleman by the name of Christopher Bush on the show. Mm-hmm. And he talked about a lot of things, but one thing in particular he brought up, and it's a very much so, you go ask any financial advisor, like a legit financial advisor. If you go ask any legit financial advisor out there, they will tell you their focus for anybody's investment portfolio is broken into one of two categories. It's either your growth or your income. Mm-hmm. Now, 9 times out of 10, when you're younger, they're going to focus more so towards growth because you can take the hit. So if you're going to be in stocks, you're going to go towards equities or other vehicles within that same type of mantra because of the fact that you're in growth mode. You still are at the very beginning, or you're still in the very high period of earning potential in your life. So again, you can afford to take those risks. But as you get older, you start to notice that essentially that they will start to adjust your portfolio so that way it focuses more towards income. So dividends, bonds, those types of things. So when the market gets a little bit choppy, and also when people start to get spooked, don't be surprised when people start to run to the bond market. Why? Because the bond market is a signal that people are starting to focus more so towards income. Now, how do we know this? Look towards, like, say, for example, specific trigger words, aka cash flows. So, like, for example, free cash flow. How much free cash flow are you holding on to? Meaning that, say, for example, of your income, how much are you holding on to, especially in a tight market? So, remember earlier in the year, I said, hey, in this type of market, it's going to be one of those typical things where it's like you can bend, but you can't break when it comes to your earnings, because earnings definitely still matter. They really matter, like, in times like this. And what they want to know is, say, for example, earnings growth, so PEG, or earnings growth just in simplicity, but they also want to know about free cash flow. So, for example, how much are you able to hold on to, or how much are you, say, for example, not holding on to? Because in this typical market, then we look towards those as areas and levels of strength. So when we start to see that a lot of those companies that didn't really have strong free cash flow, aka a lot of those companies that went public over the last 2 years, and it's not to say that a lot of those companies are bad companies at all. It just goes to show you that a lot of those companies didn't have strong free cash flow. Like, for example, your Apples, your Microsofts, and many of those other companies that are sitting there, say, for example, maybe down 20% for the year. But meanwhile, you see these other companies that don't have that type of stability. They're down anywhere from about 70 to roughly almost 88% year to date, or period. So those things tend to matter. And they tend to matter very quickly for investors. So something to keep in mind as we move forward, that essentially that when we're looking forth, those are going to be the things that are going to be trigger words over these next few earnings cycles. And the next earnings that you're going to hear about, you're going to hear a heavy duty amount of, one, free cash flow, EPS, and also whether or not you're seeing income or earnings slow down, or earnings still intact, or earnings at a steady or at a strong growth still. Earnings at a strong growth and beating on the top and bottom line, they're going to be magnificent companies. Now, they may take a hit in the stock market in the short term, but in the grand scheme of things, they'll be just fine. So then there's this other thing that where we look at it from a standpoint of, okay, well, what kind of dictates the bond market? Mm-hmm. Well, I think that one's pretty easy, right? When we look at the things that can dictate the bond market, that's where it starts to get more and more economical. So when we think about it, one of the indicators that like a lot of people are talking about PCE and CPI numbers for core inflation and stuff like that. You want to know what my favorite indicator is, Jolene?
What? What's your favorite indicator?
My favorite indicator is actually the purchasing managers index. So
Okay.
AKA PMI. And the reason why, so just as a heads up, I'm going to read the definition for everybody. The PMI is an index of the prevailing direction of economic trends in the manufacturing and services in the service sectors. So things in which that are produced, things in which that are like, so a lot of factors there, and it represents 19 sectors. So 19 sectors are represented in the PMI. It consists of a diffusion index that summarizes whether market conditions, as viewed by purchasing managers, are expanding, staying the same, or contracting. This is very key when you look at the PMI because of the fact that the PMI is measured by a level of 0 to 100. Now, 9 times out of 10, you're going to be in a range of about between, in a good expanding market, you're going to probably see anywhere from 50 to roughly 75, and in some cases 85 at max. I mean, it's very rare to find yourself out there in a 90 and 100, but in that case, it's like, yo, it's like money is flowing all over the place and everybody is just investing. I wouldn't be surprised to see that transpire as we move forward in years to come, but as it stands right now, we're probably sitting in an arena of between 50 to 60. And that's typically still good. When you look at 50 to 60, that's still good because we're still in the expansion phase. Now, when you start seeing us get to like stay the same, that's like around 30 to 40. And then when we get to contracting, that's around, let's say I'd say it's about 20 to roughly 35. And letting you know that the economy itself is starting to contract, which means that people are starting to hold on to a little bit more money and they're not making this significant types of investments. To me, I look at that as probably one of the most accurate reads when it comes to the economics, as well as when we think about business cycles. So if we think about it, if it's expanding, if the economy is expanding, then stocks provide more benefits. This is because they are gaining value as earnings improve. But if the economy is attracting, though, then the bonds are a better investment because they will protect your investment and provide you income. You need to take a water break.
Take a water break. You know, I personally prefer when the stocks are going crazy. That's my personal preference. So you said currently we're in 50 to 60 range.
Yeah, so the interesting part is that a lot of folks, through all the mess and hoopla,
Mm-hmm.
you know, we're still in this expansion phase. Like, you know, we're still the economy is still showing you, the U.S. economy is still showing you signs that it's in expansion. So, you know, we're still, as long as we hang above 50, then we're good. And so far from what I've seen on the economic data reads, we've been sitting above the PMI level of 50. So I think we saw in one particular area they were at a 60. And then, I mean, overall we're sitting at probably like about, what is it? I think we fluctuate between a 54 and a 56.
Okay, so then when we look at this, so let's stay on this bond side right quick for a moment. So
Yep.
then when we see that 50 to 60 range for the PMI,
Mm-hmm.
couple that with a low VIX,
Mm-hmm.
then wouldn't that be like even crazier expansion because the sentiment like is lower and people like risk is on.
Yeah, so normally when you get to about a 24 in the VIX and higher, then that lets you. So, okay, so here's the reading when we look at the VIX.
Mm-hmm.
When we get to a 24 in the VIX, typically the market's at a stock market correction level. So it's in between. Depending on how the market has moved and also how the VIX is played out, it can be anywhere between a 24 and 26. That's kind of like places us between stock market and bear market territory, or stock market correction and bear market territory. It could be one of those levels. Which is anywhere from a 15 to roughly 20% drop in the S&P 500 index. Okay, so when we break 24 back up to the upside, so for example, or to the downside in the VIX, that's letting you know that essentially that, you know, maybe the fear and say, for example, the short covering is starting to drop, and essentially people are becoming more and more bullish in the market. So remember how I said, like, way back when you see the QQQs at 360 or above, then that lets you know that the Nasdaq is bullish.
Mm-hmm.
Naturally, when you see that the VIX has dropped below 24, then that lets you know that we're coming out of those correction territory levels. And of course, you look for some type of stability to be found around I'd say about the 18 level, 18 or lower, to let you know that, okay, hey, pretty much the coast is clear. So we've still got a little bit of ways to run in order for, say, for example, the VIX to get there. But couple all of that together alongside with a bond market that is also starting to stabilize, because the bond market is going to immediately react just like anything else.
Mm-hmm.
And then over time, it's going to adjust itself and find a level.
Okay, so now, Mark, we're taking PMI,
Mm-hmm.
we're taking the VIX,
Mm-hmm.
and now let's throw in this balancing act that
Brother
Biden
Jerome's
was
got to
talking
play.
about, earlier, and couple that with the Fed, because what we're seeing now is, well, what's interesting is if we just look at the news, right?
Yep.
The news, first of all, is on my nerves, but the news is feeding like that fear, and it's making people like just forget about like the data. So if the data is showing us that we're currently 50 to 60 in the PMI, then there really is, we could look at these lows really as opportunity, not just because it's low, but
Mm-hmm.
because it's supported by the US like expansion, right?
Mm-hmm.
Like growth. So now we have all these indicators. I'm sure there's some other things to take into consideration, but like if we just stick right here, stop for a moment and pause, what is the tail of the tape right now?
Okay, so the tail of the tape right now, when we look at it, is that inflation did run hot.
Mm-hmm.
We're starting to see elements in which that we're starting to see that in some areas that inflation is starting to, really cool down and normalize.
Mm-hmm.
We tend to see that when things get a little bit more, okay, they get a little bit they get a little bit more under control.
Mm-hmm.
And so where we currently sit is that everybody's watching core inflation, so PCE and or is it CPE? PCE and CPI numbers.
Mm-hmm.
They're looking at those numbers to see exactly like, okay, hey, have we starting to flatten them? Have we starting to flatten out? The market has pretty much done a lot of the Fed's heavy lifting for it. So, and what do we mean by that when we say that the market has done a lot of the heavy lifting? So understand this, for a lot of folks that, are really asking, really, like, when we think about like what those bonds represent, that's a mixture of corporate and government backed. Those are government bonds. Now remember, there's a lot of corporate backed debt that also the Fed was holding alongside with government debt that it's holding. Now, of course, as it starts to ease off a lot of that stuff off of its balance sheet, that's going to be relying on a lot of those banks or banking institutions to ultimately start to eat that. Now, what does that look like for the overall economy? Like when people say that, okay, hey, that the Fed has raised rates. The Fed raises rates to drive down demand. When you drive down demand, then that ultimately allows you to build up supply. So if you think about in this type of an environment, what drove us into, say, for example, if we're in any type of recession, what has caused this quote unquote recession? It's not because the demand is there, because of course, if you look at consumer spending data, consumers are spending. If you look at credit markets are strong. So what's the problem? It's supply. There's not enough supply to handle the demand, which is ultimately driving up price. But if you can literally influence rates to say, okay, hey, well, we can drive down demand by bringing in more, say, for example, bringing into that cost. Because what happens when rates go up? What gets impacted? People tend to they tend to turn off spending
Mm-hmm.
of using certain vehicles of spending, and they start tapping more, and now you have to find yourself of, do I want to tap into my quote unquote checking or savings, does it make better sense for me to hold on to my money in my savings and earn a better interest rate? Which in this reality, cash is trash. I agree with Ray Dalio, because the interest rates that you used to get from having a savings account and like within your savings account, and it was smart to keep money there.
Mm-hmm.
Like think about it. Once upon a time, having your money in a savings account was just like having a yearly compounded interest return over a period of time just for keeping your money in the bank.
Mm-hmm.
That no longer exists anymore. So that's the reason why we say that cash is trash. So then the reason why we look at other vehicles, now it's like, okay, hey, we start to see that the bond market is starting to act up. So what does this look like just for everybody as a breakdown? When people go ahead and buy within the bond market, that ultimately will, like when people are selling, then you'll see yields go higher. Mm-hmm. When yields go higher, a yield is a potential profitability that you can take home from buying that bond. Okay, now that we've gotten that out of the way, when people are buying bonds, then that drives down the yield. It's not like it's a little bit like stock as it pertains to behavior, but it's a little bit flipped. Because when stocks get bought, the stock price goes higher. Mm-hmm. So which means that essentially your profitability, of course. But then when people buy bonds, your rate of profitability comes down. So, which means that essentially, like, okay, hey, the more that people are buying, and especially depending on the time, then the rate of their return is going to start to dwindle. So you'll go from, let's say, a 3% yield, and then the more that people are buying into bonds, you come down to a 2.5%, or say, for example, a 2% yield. Now, in an environment in which we've seen, like, say, for example, we've seen inversions take place, where the 2-year it inverted the 10-year. That meant that people were not willing to pay that 2.7 or that 2.8% on the 10-year yield. They weren't willing to buy it because of the fact that they can get a better interest yield on the 2-year. So which means that you're holding on for a fraction less of the time, but yet at the same token you're getting a sizable return. So we've seen all those things play out. So now so it went from equities, which was there was no other alternative in the market to invest in, to now the bond market started to act up, and now there became opportunity. And with that being said, now how does that come back to Brother Jerome as well as President Biden? Mm-hmm. Well, now you've seen that the market has started to act up due to supply shocks, which ultimately drove up price because of the fact that demand was there. You had to knock out demand. And when you knock out demand, then that ultimately starts to take the pressure off price and also allows you to build up supply flows. How do we know this? Look at the semiconductor space between AMD and NVIDIA. They were completely sold out of items last year across the entire board when it came to their inventory. Now their inventory is starting to make its comeback, and notice the price. You're starting to see that prices have now started to stabilize, where you can actually buy products within that space, and they're reasonable now. For example, I showed people the chip from my NVIDIA card. Those things were retailing almost up to like $5,000 just for the card. Their actual MSRP price was $1,500.
What? I didn't know the markup went that crazy.
It was because, again, scarcity. Right. Scarcity, when there's scarcity in the markets, aka, write this down, scarcity, another economic term, when things are scarce, when things become scarce, now it becomes a place in which that, okay, hey, the market becomes very much so active. If you want to get an idea, look at what happened with baby formula. Look at how that market has completely boomed because of the fact, or has completely gone way expensive, overly inflated because of the fact that there's a scarcity. Now notice what the U.S. government did. They said, okay, hey, we're getting into a defense production, which means that we need to increase production and everything else. When you do that, that helps drive down price. When you also say, for example, use interest rate hikes to attack demand, that also helps bring down price. And then boom, this is where we sit.
So that's like the balance that we were talking about earlier. Okay, so now if we're looking at so we looked at stock market, the stock side, like those types of indicators. I feel like there was something else that was missing, but maybe I'm wrong. And then we looked at bonds and we looked at
Yep.
growth indicators.
Yep.
So what's next?
So another thing that we're looking at is, say, for example, a thing that is called a weighted average cost of capital. Now, this is something in which a lot of folks aren't really talking about, but you know what? I would be remiss if I did not give homage to our cousin Q. Shout outs to the run-up cousins out there. That where it's like where you have conversations like that, you start having conversations as it pertains to the cost of capital. Now, of course, there's a formula that's built into it, but I'm not going to go too deep because, of course, we won't have that much amount of time for me to go through running examples. But I'm going to keep it very much so simple for folks to understand, and I'm going to give you the definition first. So, pretty much, weighted average cost of capital is a weighted average of a company's cost of debt and cost of equity. A stock is cheap or expensive only in relation to its potential for growth or lack of it. So if a company's share price plummets, its cost of equity rises, also causing its weighted average cost of capital to rise. So when we think about, like, for example, when you start hearing about people talking about, you know, the stock is trading at 10 times earnings or 9 times earnings. The stock is considered cheap, and when we look at what it's doing, a lot of folks for a long period of time looked at Apple as a stock that's traded significantly cheap because of the fact that it's always traded within the teens or the low 20s as it pertains to its ratio or its forward earnings. And when we say forward earnings, over the next 12 months.
Mm-hmm.
So when we start to see that, say, and how is weighted average costs, like, how is that all formulated? So to keep it very simple and very basic for everybody, when we think about weighted average cost of capital, think about it like this. The amount of money that you spend, so I'll just remember WACC, the amount of money that you spend, how much of that is going to come back, and what does that produce for the company? So let's just say I go out there and spend, $1 million.
Okay.
I go out there and spend $1 million for a company. In return, what do I expect in me spending that $1 million? What do I expect over the next 12 months, or say, for example, 18 months? What do I expect that to bring back to the company? If it's not bringing back, say, for example, $1 million, then that's not a one, right?
Mm-hmm.
If it's, say, for example, bringing back, say, for example, $250,000, then, I mean, then my WACC is going to be pretty low, which means that essentially now if you look at my stock, now that's considered a little bit too high price of a premium because of the fact of what you're able to get back in value versus what is being spent isn't there. Mm-hmm. So when we talk about the cost of capital, when we talk about, say, for example, looking at companies in today's market, you have to look at it in the sense of when you go through their earnings, how much are they spending and what is the value that they're returning? So if Apple is going to be able to borrow $90 billion, but yet Apple over the quarter brings in over $100 billion in revenue, and whatever they're spending $90 billion on is going to bring in, let's say, over a course of, let's say, 5 to 10 years, $1 trillion in revenue over time, then that's money well spent. That brings back significant value, and the stock is now justified at that price.
So this reminds me of a conversation earlier, a couple episodes earlier. It could have been last year, I don't remember. But talking about when the company, like looking at a company like Amazon over the years, taking their money and like reinvesting it back into research and development and seeing it play out over, years later.
Correct.
So if we look at that's another really good indicator to see, like, what this company's growth trajectory is looking like. But we also have to look at it. But sometimes companies can reinvest, Mark, and it's a miss.
Correct. That is true.
I'm trying to think of an example like
Rivian.
Well, I was also thinking of like Beyond Meat too. I don't know how much they've like reinvested into their company, but they've made some decisions that are not good overall. Like
Here's a cheat sheet, Jolene, for the folks. Here's a cheat sheet for Jolene. Companies that are, say, for example, like a lot of folks look at growth companies and like, okay, hey, well, they look at it like in the sense of discounted cash flows and everything else.
mm-hmm.
But the real growth companies, the ones that are literally staging themselves to literally be the next gen of leaders,
Mm-hmm.
they're the ones that you know that they're making money. But instead of them like looking to pay back a dividend so early, they're looking to their dividend that they're paying back into the company is them making that reinvestment back into the company so that way the company can grow even further and expand.
Gotcha.
The companies that like naturally focus more so heavily towards returning value to shareholders, ask yourself this. What is it that they're doing over this period of time that since they're returning all this money back to shareholders over a period of time, well what will they be doing in the next 10 years? Over the next 5 years?
That's a good point.
Like from the mind of, like I'll give you a heads up into the mind of like say for example thinking like VCs.
Okay.
And why is it that they drop money into companies? And like notice, VCs, it's not like they're just, we're not just dropping money into companies just willy-nilly. That's not how it works. I mean, of course, we have to see that the business model is supported by the economics, and the economics ultimately validate the business model. But then there's a whole nother part to that. We're willing to wait 5, 7 years to see something solidify for it to get to X amount of for it to get to X amount of value, or for it to return X amount of value over a period of time.
Mm-hmm.
When Paul Sue came onto the show, that's where you get into that mindset of thinking about the return over time. That's that 100x or that 1000x, in which that every VC looks to focus on in a startup that they would invest in, though that the average is about 35x return. And in some cases, on your very beginning funds, it's about maybe 15 to roughly 20x return. So, but when you think about it, it's like they're willing to make the necessary time and say, okay, hey, keep reinvesting that back into the business. Why? Because you go from startup where you're needing capital to growth where you need a little bit of capital, but you more so use that cash that you build in reserve to essentially, if you need to, you can use that as leverage as it pertains to borrowing capital later on, whatever you need. And then when you get to a level of scale, you're using this consistent cash flow cow that you've literally put together to consistently keep reinvesting into the company, making the business, making the service better. And ultimately, as you're doing those things, the business itself flourishes. Like, that's the ultimate point there.
Now, I just want to put this on the record now. What time is it? 6:23. So when you all are watching the playback, that last section of what Mark was talking about with the VCs and the value and how you use the money and how, like, what you're expecting in return, I want you to pay attention to that part, because there is something coming down the pike a little later, but I want you to pay attention to that part so that then, those of you who know will know.
Yes.
And
it's coming a lot quicker than people think.
Yeah. Just remember that part. It'll make sense. It'll make sense later, but I'm just telling you now to be aware of that last section. It'll make sense a little later. Okay.
Indeed.
I mean, I'll sip to that, Mark, because
Mm-hmm. My focus, our focus, Jolene, is that people were always knowledgeable, and that when the time came when it said, okay, hey, we out like Harriet. Are you ready? Or are you going to be? You need to go around you need to wait for the next round, for the next bus to come around. But yeah, those are the things that, like, when we look at in this current climate of today's market, and here's another thing. Like, I'm gonna leave you guys with this final piece of information. Where we talk about narratives.
Mm-hmm.
When you guys look towards the media, like, for example, for those in whom wish that whether you watch CNBC, CNN, MSNBC, notice how the talks of, say, for example, specific markets are also looked at as lagging indicators. Like, notice the amount of chatter. Like, if you get the chance, go back and look at when you started hearing about, like, for example, market crashes or bear markets. If I get the chance, I'll probably post it up on Twitter if I could find a chart that could show that. But every single time when the media gets at its high peak of where it's like it's now in the conversation of everybody, excuse me, the interesting thing is that's around the same time that the market tends to prepare itself to take a turn. It never ceases to fail, but it always happens when, say, for example, like I said, you can use certain things as a barometer to see exactly where you are in, say, for example, the narrative cycle, where we are in the economic cycle, but always, again, use the data to always verify and validate. But when you look at businesses, here's the easiest way to look at it, because in the same way that we look at it for startups, we look at it in the same way for publicly traded companies. The number one question that I've always asked myself when it comes to, signing a term sheet or writing a check towards a startup is it supported by the economics? And does the economics validate that this business belongs? Or is it too ahead of its time? Or whatever it may be. The same rules apply when we look at publicly traded companies. The same rules apply. Like, okay, look at the current market of companies. Look at the companies that are currently happening right now. There's a reason why energy is the leading sector and now has started to accumulate some of that weighting in the S&P 500 today. It went from being weighted at 2.5% to now, if we look at it today, in December 31st of 2021, S&P 500 energy was at 2.67. Here's your homework tonight. Go find out exactly what its weighting is today. Go find out exactly what its weighting is in the S&P 500 today. Again, the economics will always they will always validate and verify the business. You just need to know, if you're looking at a company, does the company that you're looking to be invested into or looking to even trade in the long term, is that business supported by the economics? If it's not, then there's a problem.
Well, we have 2 minutes, but we do need to announce some things. One, Sector Sundays. Or excuse me. Oh, I am like in a time zone right now. Okay, sorry. Supplemental Sundays. Coming in on it'll be taking place this Sunday. So be sure to come back on Sunday to our channel to check that out. And it's a really good opportunity to kind of like, you get in where you fit in and fill in gaps in information that maybe during this show we don't have enough time to go over. So there may be, more explanation on Sundays. So it's a good time to bring another pencil, whatever, and take notes. And, it almost feels like financial church, like, so, fellowship and finance. So, Mark,
yes,
we'll be back on Tuesday.
Yes, we will. Yes, we will. And, I may be in a different location next Tuesday, just as a heads up.
Maybe you will be, Mark.
No, I will be. I will be in a different location. I'll be in a different time zone.
Time zone too. Okay, make sure you.
Oh no, I'm coming through like coffee out here.
Okay.
No, I don't drink it, but I'm coming through like it.
Well, I definitely do. All right, Mark. So that's it. That's all she wrote. This was very, very informative. Per usual.
I hope I didn't overload everybody with too much information and go too much in depth. But that's the beautiful thing about it being on YouTube. You can always come back and rewatch it and upon the replay.
On the replay.
Y'all, thank you so much for rocking with us. Hopefully that you had some great insight. Share this video with someone that you may know that is interested in getting into the stock market, or somebody that even needs a little bit of, to be consoled and understand and a little bit more further perspective. This will greatly help. And honestly, again, just keep learning, keep researching, because the more you learn, the more you earn. And it's not always about what's happening right now. Sometimes you have to look further and see exactly what things look like in the grander design. Until next time, I'm Mark Monroe.
And I'm Jalen GC, and the place to be.
And this was hopefully your come up. Thank you for rocking with us here at the School of Investing. We'll see you next Tuesday. Peace, y'all.